If you do wait to invest when you see a pullback, what are the areas that you're looking to deploy into?
Right now, what looks relatively attractive is in the securitized area. It's in areas of the market that have been beaten up due to the rise in interest rates and the interest rate volatility. And then, the sectors that look rich to us that should come under pressure are more in the corporate bond area. Obviously, the further down the capital structure you go, or the further down you go in credit quality, should be where you see the most opportunities. I'd add one more thought too about kind of the current economic environment. And certainly we would concede that the mix of the last 2 months of data would indicate a slowdown, but at least looking over the rearview mirror for the past couple of months, it doesn't indicate a recession. But I had heard a guest earlier before Kelly and I jumped on, said something about looking at the employment market right now and not being really worried. We would contend this, the U.S. economy makes the Titanic look like a dinghy, meaning that when you actually finally get to the point where you are really worried, it's going to be too late. At that point in the time, the Fed's going to have to be reacting, aggressively. And then that kind of the psychology, that negative feedback loop you're going to get at the consumer level and the corporate level, you'll start to see the layoffs. And at that point in time, it's going to be too late, because the Fed will be reacting, spreads will be much wider.